Bitcoin is slowly but surely becoming part of every smart investor's portfolio, and BlackRock just released a report titled Bitcoin, a Unique Diversifier, confirming that they seem to also believe, conveniently having now facilitated a Bitcoin spot ETF, that actually Bitcoin belongs in your portfolio as a diversifier. And in this video, we're going to be diving into this report just published by BlackRock, looking at Bitcoin and why they believe it should be a part of your portfolio. Without further ado, ladies and gentlemen, let's get into this report from BlackRock. So this report was published a couple of hours ago. And of course, as we've previously stated, the report is titled Bitcoin, a Unique Diversifier. Why Bitcoin's appeal to investors lies in its detachment from traditional risk and return drivers. Now, when we talk about, you'll often hear in the investment space the word alpha get thrown around, and alpha in regards to portfolio management is all about finding uncorrelated assets that will minimize your downside but maximize your upside, and Bitcoin seems to tick many of those boxes. Let's move on to the foreword, and we can see the foreword says Bitcoin has undergone a historic journey over its 15 years of existence, rising from obscurity to become an asset held in varying degrees across the world by an expanding number of individuals and institutions. While BlackRock's first client offerings around Bitcoin first launched in 2022, the years preceding that represented an important period of study, monitoring, and client engagement for us. As a fiduciary, we seek to provide access and choice to clients to meet their individual needs. As with any other asset class, when clients express a need for access, we work to offer them more investment options. But offering our clients choice is a first step. We must also closely examine performance and engage in our own research to educate clients. In the case of Bitcoin, we strive to bring this same measured approach to our clients as they seek our insight on this highly unique and relatively novel asset. We believe that Bitcoin, via its nature as a global decentralized, fixed supply, non-sovereign asset, has risk and return drivers that are distinct from traditional asset classes and that are fundamentally uncorrelated on any long-term basis. We maintain this conviction even as short-term market trading behavior occasionally diverges, in some cases profoundly, from what Bitcoin's fundamental characteristics would suggest. We observe this as recently as August 5th, 2024, when Bitcoin saw a one-day drop of 7%, alongside a 3% fall in the S&P 500, as global markets experience a sharp pullback related to the unwinding of the Japanese yen carry trade. This episode coincided with a series of Bitcoin-specific events related to long-pending bankruptcy distributions and liquidations, Genesis, Mt. Gox, that had already been unfolding over the preceding 3 days. That was then exacerbated by the scramble for liquidity caused by the global market sell-off that was taking hold. As has been common patterns during these occasional episodes of short-term, sharply negative co-movement with equities, Bitcoin's price rebounded, overtaking its level from before the sell-off within 3 days. We view this pattern as instances of fundamentals eventually prevailing over short-term leverage trading reactions. As Warren Buffett has said, the stock market is a device for transferring money from the impatient to patient. This wisdom has also tended to be true for the Bitcoin market throughout its history. We present in the enclosed our best attempts to capture, in response to great interest for our clients, the dynamics of Bitcoin today as it pertains to risk, return, and portfolio interactions. We do so in recognition of the early stage Bitcoin is at in its journey and the rapidity with which its adoption and understanding by the global investor community is evolving. Ooh, exciting forward. Let's dive into some key points on page 2 of this report. Investors considering allocating to Bitcoin are grappling with how to analyze it relative to traditional financial assets, given Bitcoin's unique properties and limited history. Point number 2, Bitcoin with its high volatility is obviously a risk asset on a standalone basis. However, most of the risk and potential return drivers Bitcoin faces are fundamentally different from traditional risk assets, making it unfit for most traditional financial frameworks, including the risk-on versus risk-off framework employed by some macro commentators. Point number 3, Bitcoin's nature as a scarce, non-sovereign, decentralized global asset has caused some investors to consider it as a flight to safety option in times of fear and around certain geopolitical disruptive events. Over the long term, Bitcoin's adoption trajectory is likely to be driven by the intensity of concerns over global monetary stability, geopolitical stability, US fiscal sustainability, and US political stability. This is the inverse of the relationship that is generally attributed to traditional risk assets with respect to such forces. An introduction. Is Bitcoin a risk-on or risk-off asset? That's one of the most prevailing questions our clients asked us as they considered investing in Bitcoin for the first time. The answer, we believe, is that Bitcoin's unique nature makes it unsustainable for this and most other traditional financial frameworks, and that Bitcoin's long-term return drivers are fundamentally uncorrelated with other sources of portfolio returns. While Bitcoin has been volatile and has seen short episodes of co-movement with equities, particularly during episodes of sharp shifts, US dollar real interest rates or liquidity, Bitcoin's long-term correlation to equities and bonds has been low, and its long-term historical return have been vastly higher than all major asset classes. Over extended time horizons, we believe Bitcoin's adoption drivers are likely to be distinct from, and in some cases inverted with, the global macro factors that drive most traditional financial assets. In this paper, we seek to explore this dynamic. Let's tuck in. Why Bitcoin matters. Remember, this is a report from BlackRock, ladies and gentlemen. Firstly, it's important to ground ourselves in the fundamentals of what gives Bitcoin its relevance. With its creation in 2009, Bitcoin became the first internet-native monetary infrastructure to gain broad global adoption. Its technological innovation was the creation of a form of currency that was digitally native, global, scarce, decentralized, and permissionless. Because of these attributes, it produced major breakthroughs in multiple century-old problems that the other forms of money had struggled with. Bitcoin hard cap supply at 21 million units means it cannot be easily debased. Its global, digitally native nature means it can be transported anywhere in the world at near real-time and net zero costs, transcending the frictions long inherent in moving value across political borders. Its decentralized, permissionless nature made it the world's first truly open, accessible monetary system. So what makes Bitcoin relevant? Persistent historical challenges around money, prone to inflation and debasement given a non-fixed supply, difficulty to transact across borders, access to one particular country controlled by central authorities, what Bitcoin made possible, fixed maximum supply of 21 million units, with supply growth declining every 4 years, digitally native, borderless, permissionless, near instantaneous global transfers of value, first truly open access global monetary system. While other crypto assets have since been built on the back of Bitcoin's original breakthrough, in many cases in pursuit of a wider breadth of use cases, there has been a global coalescence around Bitcoin as the preeminent asset in the space. This has given it a position ununiquely amongst the crypto asset universe as a global monetary alternative and an asset with credible scarcity. Bitcoin's path to $1 trillion market capitalization. Despite Bitcoin's remarkable rise and significant global adoption to date, its potential ultimate development into a widespread store of value and or global payment asset remains uncertain, and Bitcoin's evolving market value reflects the uncertainty. Bitcoin outperformed all major asset classes in 7 of the last 10 years, leading it to an extraordinary return in excess of 100% annualized over the last decade. The performance was achieved despite Bitcoin also being the worst performing asset in the other 3 of those 10 years, with 4 drawdowns in excess of 50%. Through these historical cycles, it has shown an ability to recover from such drawdowns and reach new highs despite these extended bear market periods. These movements in Bitcoin's price continue to reflect, in part, its evolving prospect through times of becoming adopted on a widespread basis as a global monetary alternative. And you can see here, very much showing the Bitcoin 4-year cycle theory chart. It's amazing that BlackRock are writing about this. It really kind of, and you saw this with gold, they allowed a gold ETF and then started to promote it to clients, which is very much what they're doing here. And we'll get to the conclusion in just a second. So an uncorrelated asset, Bitcoin reflects little fundamental exposure to other macro variables, explaining its low long-term average correlation with equities and other risk assets. While there have been brief periods where Bitcoin has seen its correlation spike, particularly around episodes of sudden shifts in US dollar real interest rates or liquidity, these episodes have been short-term in nature and have failed to produce a clear long-term statistically significant correlation and relationship. You can see this is, of course, the figure that they are putting forward. You've got Bitcoin and you've got the likes of gold. Sometimes actually adversely correlated. However, I think as they're sort of stating when this sort of events, you know, the correlation does get a lot more apparent. Bitcoin, as the first decentralized non-sovereign monetary alternative to gain widespread global adoption, has no traditional counterparty risk, depends on no centralized system, and is not driven by any one country's fortune. These properties make it an asset that is largely detached on fundamentals from certain critical macro risk factors, including banking system crises, sovereign debt crises, currency debasement, geopolitical disruption, and other country-specific political and economic risk. Over the long term, Bitcoin's adoption trajectory is likely to be driven by the degree to which concerns rise and fall over global monetary instability, geopolitical disharmony, US fiscal sustainability, and US political stability. Because of these attributes, Bitcoin has been seen by some investors as a flight to safety. In times of fear amid some of the most disruptive global events over the last 5 years, notably in some of these instances, Bitcoin first exhibited a temporary negative reaction before subsequently rallying. In our view, these short-term trading reactions, which are often difficult to explain based on fundamentals, can be attributed to the combination of the fact that Bitcoin is an asset traded 24/7 and settles to cash near instantaneously, making it a highly saleable asset during periods of stressed liquidity in traditional markets, particularly over weekends, a function of a still immature nature of Bitcoin and crypto asset markets, and of investors' understanding around Bitcoin. In most instances, including the recent global market sell-off of August the 5th, 2024, Bitcoin has recovered back to its prior levels within days or weeks, and in many cases has rallied further as a recognition of the positive potential impact of such distributive events on Bitcoin's fundamental begins to dominate. And you can see this is S&P 500, gold, and Bitcoin through major geopolitical events. And you can see here we have US-Iran escalation. Bitcoin obviously won out here on the 10-day return, and on the 60-day return also did a similar thing. The breakout of COVID, you can see Bitcoin actually sold, everything sold off here, but it started to then outperform on the 60-day return. 2020 US election challenges. Again, we see major overperformance on both the 10-day return and the 60-day return. the Russia-Ukraine invasion. You can see it sold off harder but returned more significantly on the 60 days. US regional banking crisis, you can see Bitcoin performed very well, and the yen carry trade, this report is still digesting the data. Exceptionally interesting report thus far. US debt dynamics re-entering focus. Along this vein, the growing concerns in the US and broader over the US's federal deficit and debt has increased the appeal of a potential alternative reserve asset as a potential hedge against possible future events affecting the US dollar. This dynamic appears to be also taking hold in other countries, where debt accumulation has been significant. In our experience with clients to date, this explains a substantial portion of the recent broadening institutional interest in Bitcoin. You can see this is what we're seeing: US deficit, US federal growth. You can see the correlation here. This is ultimately what Bitcoin was created for. So Bitcoin is still a risky asset. None of the prior analysis negates the fact that Bitcoin on a standalone basis is still very much a risky asset. It is an emerging technology that is still early in its adoption journey towards potentially becoming a global payment asset and store of value. Bitcoin has also been volatile and subject to myriad risks that include regulatory challenges, uncertainty over the path of adoption, and a still immature ecosystem. The key point, however, is that these risks are unique to Bitcoin and not specifically shared by other traditional investment assets. Bitcoin, as such, is a particularly poignant case study in why simple risk-on versus risk-off frameworks can lack the nuance to be broadly useful. From a portfolio perspective, this is why Bitcoin held a modest allocation can have diversifying effects on portfolios, whereas at larger position sizes, it elevates standalone volatility, starting to have an outsized impact in increasing portfolio risk. Remember, this is the largest asset manager in the world writing this paper. They go on to conclude, while Bitcoin has shown instances of short-term co-movement with equities and other risk assets, over the long term, its fundamental drivers are starkly different and in many cases inverted versus most traditional investment assets. As the global investment community grapples with rising geopolitical tensions, concerns over the state of the US debt and deficit, and increasing political instability around the world, Bitcoin may be seen as an increasingly unique diversifier against some of these fiscal, monetary, and geopolitical risk factors investors may face elsewhere in their portfolios. Again, I just want to stress, that is the report concluded. This is BlackRock, the largest asset manager in the entire world, basically writing a report to their clients on why Bitcoin might be a good diversifier to have in your portfolio. And we have only seen a fraction of the money that is going to be allocated to Bitcoin actually get allocated. Nothing short of bullish. We wanted to share that report with you. Let me know your thoughts in the comment section, and I'll see you all in the next YouTube video.